Josh Brown, welcome to the Long-Term Investor.
Thank you so much for having me, Peter. It's a pleasure.
Well, I actually am just so excited to have you, as I mentioned in the introduction, because you're so uniquely positioned to comment on markets, the economy, the business of financial advice, just because of where you sit professionally. But I think one thing I didn't mention in the introduction that I have to mention now is that you also paved the way for people like me to have a voice and have a platform to educate, to help others. So truly, thank you from the bottom of my heart. I just want to make sure that you know how important of an impact you've had on my life and on others. Truly a legend for those of listening and who don't know Josh, but truly, Josh, thank you so much.
Well, I really appreciate hearing that. And it's kind of cool because I feel the same way about a lot of people who came before me that I had learned from and been inspired by. So hopefully this continues and there will be a generation of market commentators, financial planning podcasters who say the same thing to you someday.
Boy, wouldn't that be an honor? And I remember starting in the blog world, just being like, I want to do what Barry Ritholtz is doing. I want to do what Josh Brown is doing. And trying to describe that to some of my partners was difficult. But there really has been a huge shift where what you and I do now is pretty normal. Maybe can you just start by sharing your own story, describing to the audience how the world shifted from traditional media to the blogs, the podcasts, social media, et cetera?
Well, I think there was a moment during the financial crisis where it became obvious that the mainstream media had missed the story, or they had reporters who were doing good articles but weren't really getting to the heart of what was happening. And part of the reason for that was that the reporters were talking to traditional sources, people that came from Goldman Sachs, Merrill Lynch, Bank of America, JP Morgan Chase, and they were media-trained people who were not telling the whole story because they couldn't. Or sources that they had previously relied on from the government, and just people that didn't really want to tell the full thing of what was happening because it would make their institution or corporation look bad. So there was a hunger for non-traditional sources of information in the financial markets, and there were a small group of people who had been independently and really for no monetary compensation whatsoever, just people who had taken it upon themselves to be writing financial blogs about the markets, the economy, the crash, the mortgage problem, the housing problem, and those people became rock stars. And there were, 10 or 15 of them. One of them was Bill McBride at Calculated Risk, who effectively predicted the crisis using data. Then there was Barry Ritholtz, who predicted the crisis using a combination of data and anecdotes and curse words. And, there were several others. But Barry, very uniquely, had been writing about the stock market and behavioral finance and knew a little something about real estate because his mom was a realtor. Barry had this one very unique insight. And I know we're doing this audio, so you can't see what my hands are doing
too, so you can do hands.
All right, so I'm from Long Island. We talk with our hands. So Barry basically said, here's a chart of housing prices, and it goes from the lower left to the upper right, almost like perfectly diagonal, just up and up and up and up during the 2000s decade. Here's a chart of average incomes, and it's a flat line straight across the bottom. So Barry's big insight is this is very simple. Either everyone in the country is about to get a 200% raise, or the price of houses is completely unsustainable and is about to crash. And of course, it's the latter thing that happened. And he saw it coming. He documented it meticulously. I don't mean one article. I mean he wrote about this 5 times a day for 3 years, and then it happened. So Barry is effectively at the vanguard of this new crop of market commentators who were not coming from a traditional gatekeeper. They weren't sent by a publicist to go on the air, working for one of the larger firms. And that's really the beginning, I think, of the financial blogosphere. And then, of course, I am working on Wall Street during that crisis, and I'm trying to be able to figure out what's happening. And I'm reading people like Barry. So Barry kind of becomes my idol. And I say, when I grow up, I'm going to start a blog. So, of course, I started one 5 minutes later. And I got to meet Barry as a result of both of us being part of this movement of independent people kind of calling it like we saw it. And, once we met, it became obvious that there were a lot of complementary skills and we could work together.
Well, and so the traditional media landscape changed, and you guys were sort of at the forefront, at least in the finance corner of the world, because this is true of really any sort of commentary, whether it's sports or fashion or entertainment. Everyone can have a blog. It's almost costless at this point. But, if that was maybe the big change in my career of how people consume information, the other change that you talk a lot about in your book is just where Wall Street profits went. So over time, the bull market of the 2010s, I feel like I've heard you and others and myself say like, oh, it's the most hated bull market ever because no one on Wall Street was making any money.
Yeah.
Big theme throughout the book. Can you talk a little bit about just the enormous gains of passively managed ETFs, how traditional money management firms and the brokerages and the investment banks who are catering to them sort of didn't profit from a huge, huge bull run?
Yeah, index funds and passive investing effectively went from 5% to 50% of the market. And what that meant was an enormous amount of outflows from actively managed mutual funds. Like, we're talking about trillions of dollars moving away from high fee, actively managed funds and strategies over to index funds, which effectively Wall Street makes no money on. Like, if you pull out BlackRock and State Street, there's nothing there for anyone. There's some revenue on the trading side to be a counterparty with the authorized participants who are buying and selling stocks to create or redeem the baskets that are the ETF's holdings, but that's not a high-margin, glamorous business. The really glamorous business on Wall Street in terms of asset management was being the person who runs, a $50 billion actively managed large-cap mutual fund. And those effectively began a long, slow march toward extinction. It's not that they're not good at their jobs. It's that their jobs are impossible. No one can literally, year in, year out, beat the S&P 500. The S&P 500 is the ultimate momentum machine. The best companies become the largest weightings. And if you don't own the top 10 stocks in at least a market-neutral weighting, you are destined to lose. How likely is it that somebody can pick the top 10 stocks every year? So it's almost an exercise in futility. Investors ultimately figure this out. We probably played some role in that with all the blog posts and all the commentary. And so Wall Street finds itself in a position where there's a massive bull market happening, but the industry itself is not cashing in the way that it had historically during previous bull markets. So there's still M&A. There's still syndicate business, IPOs. It's not that no one's making any money, but it is sort of joyless. And you look at these firms that historically they would have been hiring 20, 30, 40,000 people in a bull market. We actually had some unbelievable years for the S&P 500 where you saw the largest firms on Wall Street laying people off. It's pretty unheard of. So it was kind of like a joyless, sexless, anticlimactic thing for professional Wall Street people to watch the market continue to hit record highs while their bonuses didn't. And it was kind of an interesting moment in time.
Yeah, there won't be any movies made of the great bull market of the 2010s. Obviously, like there's The Big Short and that sort of stuff, but you don't have these Wolf of Wall Streets or Wall Street to look back and glamorize some of the parties of Wall Street.
Peter, meanwhile, the S&P 500 compounded at 14%. Right. So people did win. It was just they were regular people.
Yes, regular people won, and that's because financial advisors weren't getting paid to shovel these high-cost products into their accounts. I think that's, there's been a big shift in the business model, and I don't know. I'd love to hear your thoughts on my theory. I feel like private equity, private credit, private real estate, not inherently bad, but to me, like this is the new asset management. This is how Wall Street is going to make up lost profits, because those are active managements. They're super concentrated, actively managed funds with very high fees. Maybe that's the next place that allows people to go into that sexy finance career. And
Listen,
if you rewrote this book 10 years from now, that might be the focal point.
I could not agree with you more. And I'm going to tell you, Wall Street, how can I say this politically, delicately?
It's okay. Go for it.
Wall Street will sell you whatever you will buy. Wall Street doesn't sit and say what's in the best interest of investors. Wall Street says, what will investors pay money for? That's it. And there's nothing wrong with that. This is no different than record companies. They're not like, what's the best music? They're like, what's the music that is most likely to become commercially viable so we can sell a lot of concert tickets and albums and streams and merchandise? So Wall Street doesn't sit in a room and say, how do we get people to pay more for actively managed mutual funds? They don't care. They're, okay, fine. People won't pay for that. What will they pay for? What is unique enough that Vanguard can't replicate it for free? And the answer is private equity, alternatives. Like what is something, all right, we can't get 1% anymore for a large cap growth fund. The jig is up. Everyone knows the SPIVA scorecard. Everyone knows there's no persistence of returns. Everyone knows that a manager who is 20th percentile performance is as likely to be bottom 20th percentile 5 years later as they are to be top. Everybody understands this at this point. Morgan Housel and Ben Carlson made sure that everybody would, okay, fine. So they won't pay 1% for that. What will they pay 1% for? That's it. And then once they figure it out, people are really into this alts thing. You got high valuation stocks. You got bonds yielding almost nothing. We could tell a story where those two asset classes should not be the only thing you should own. You should have this third thing that will be non-correlated, LOL, will be less volatile, super LOL. But like we could get people to pay 1% for this. So that's what they're doing. And it's fine. There'll be winners. There'll be losers. 90% of this stuff won't work. 10% will. Very few financial advisors are capable of determining in advance which is going to be the 10%, which is going to be the 90%. So we'll replay the whole thing. And, in 3 years and 5 years, my firm will be unwinding all of these bad investments. And so I love it. It's great. We'll just, we'll write blog posts and we'll do our thing. And then I think you'll be exactly right.
Well, I think you're, and that's what's great about what your firm does. You have so many writers with such a large platform, educating not just the public, but the advisor community who is probably not as educated as I would prefer them to be. I realize the new advisor today knows a lot about taxes, knows a lot about financial planning, at least the good ones. But, people are always going to want to chase what worked, and asset managers are always going to want to put out what just worked into the market. So after the tech bubble, it was hedge funds. After the great financial crisis, it was managed futures. At some point in the 2010s, it was liquid alts, and you see the 60-40 is dead. But I'm one, and I think you are too, who just generally prefers simplicity over complexity. Wall Street sells complexity. I mean, is it really just as simple as they're giving people what they want?
Yes.
Yeah.
So, okay, this is important. Why is private equity so hot? We know why it's hot from the selling perspective. Like, why are companies selling private equity funds to wealth management? Because there's a lot of money to be made. Why are people buying it? Why are advisors recommending it? Because everything is sold on a backward-looking basis. So if I am creating an investment proposal for you, I just met you. Maybe we played golf. Maybe we shared a couple of laughs over cigars at the club after. And then you said, Josh, what do you do? And I said, I manage money. And you say, I've been looking for a new financial advisor. Maybe let's, swing by my office. Let's have a conversation. Blah, blah, blah. Couple meetings. And now I'm making the portfolio presentation to you. So I say, all right, Peter, we talked about your goals. We did a financial plan. You agreed with me that the portfolio should be based on the plan. Well, here's the portfolio, and these are the holdings that I'm proposing to you. So I want you to have X percent in U.S. stocks, X percent in international stocks. This is what we're going to do in tax-free munis. This is what we're going to do in treasuries, blah, blah, blah. And here's a 10% sleeve in private equity. Why did I do that? I'll explain to you why. I'm a fiduciary, so I'm not getting an extra fee for doing that. Okay, but here's what I get. I get to show you a historical track record of private equity as an asset class back to the 1980s. It's going to include the returns of Carlyle, Bain, and KKR from when they were managing like $10 million. Of course, they're now managing $1 trillion, but forget about that part. So I'm showing you historical returns that will never, ever be replicated. Can't be. Mathematically impossible, okay? But still, I'm showing you, I'm baking that into a backward-looking, a back test of the, okay. So that makes me look really good. The second thing, it looks different than what the RIA down the street is showing you. The RIA down the street is showing you a portfolio with 8 ETFs, 5 are BlackRock, 1 is State Street, 2 are Vanguard, or whatever. And you're looking at that, you're like, oh, I could do that myself. And anyone could do that. I can, right? I can call Fidelity, and the clerk who answers the 1-800 number could build that portfolio. So I'm showing you something different. I have an interval fund from KKR. Ooh. How does that work? Well, you see, it's very exclusive. These are private assets. They don't trade all the time. You're only going to get an update on the valuation every quarter when they remark the portfolio. There's a liquidity constraint, so even if people are panicking, you can't pull your money out all at once. And this is how billionaires invest. So I tell you, and it's true. Now, billionaires don't invest through a mutual fund, but that's another conversation. The point is, I get to show you a level of sophistication on my part as the advisor that separates me from the other RIA in town who's doing 8 ETFs from Vanguard. I get to utilize historic private equity asset class returns as part of my back test. And that's, even though I don't get paid any more or less to build a portfolio with that 10% alt sleeve, in your eyes as the prospective client, I have materially elevated myself as an advisor and the value of what I bring to the table. And it's as simple as that. And anybody who wants could say, no, it's not true. It's non-correlated. No, it's not. That's not why you're doing it. So it's okay. I'm not against private equity, but just keep it real. Like, tell the truth. We think this asset class has some non-correlated attributes. We think the benefit of the illiquidity premium will exist. Okay, that's legitimate. We think private equity could potentially outperform the S&P 500. Okay, it might. You're not buying private assets at the same valuations that people were in the 90s, but sure, maybe it's still outperformed. But just be honest with your client. Why are you doing a 10% alt sleeve? Why are you selling private credit to a dentist who's looking for 7% returns? What are you doing? So you and I understand this. I think most people listening to this who are advisors understand this. The clients, there's a spectrum. Most of them have no idea what's going on.
Yeah, I think that's
Have
totally
I been canceled yet?
But no, not at all. I mean, I think, if I think of the advisor, I'm not going to go trashing advisors per se, but I do feel like it's also just another place to, if it doesn't work, it's really easy to come up with some narrative about the Fed or geopolitics on why the thesis didn't work out, and that's why this underperformed. But here's a new manager. Did you just keep this cycle going?
100%. And can I also tell you, if I sound overly cynical, it's because I did this already. We did this in the 2000s. You had a lost decade for stocks in the 2000s. The S&P 500, it was flat with a ton of volatility. 250% crashes inside of 5 years. and a decade of 0% returns. So what do you think people did in 2010? They started recommending commodities funds. All of a sudden, commodities should be a 10% sleeve in a long-term asset allocation. I swear to God, that was the standard advice. Why? Because commodities did really well during the 2000s decade. So you could point to a client and back test and say, if you had been working with me for the last 10 years and you had the portfolio I'm recommending to you today, look what commodities would have done to offset the weakness in stocks. They did it with emerging markets, the BRICS trade. They said, here's your problem. You know why you're dissatisfied with your current advisor? Because you're all U.S. Had you been working with me for the last 10 years with the portfolio I'm proposing today, we would have been 10% emerging markets, BRIC stocks, Brazil, Russia, India, China. And look how well those did while your S&P funds were put to sleep. So all of a sudden, between 2010 and 2014, everybody's being recommended a portfolio that is an answer to the last war. Every general fights the last war. So now all of a sudden, people are walking around like, I'm 10% commodities. This commodity sleeve never goes up. Or it goes up and down and up and down. What is the point of this? There is no point. The point is you were willing to buy that because you were mad about stocks having done nothing for 10 years. This is human nature. It's not the advisor's fault. In the end, if you're selling and you're trying to close business, you will default to whatever the customer is willing to buy. It's really hard to insist that they do something that looks like it just was a complete failure for the last 10 years. Even if you think it's the right thing to do, it's not the easiest way to close new business.
100%. And it's hard to retain business sometimes because people still today think that the value we add on the investment side is investment selection. And I'm not saying there's no value add there, but for the most part, we're here to just make sure that you don't make mistakes. And I feel like, at least in my career, so I started in 2007, my first bear market, I remember being like, so this is what a bear market feels like? Cool. So like I'm anchored to the 60% drop thinking that's normal. And in all of 2022, I keep saying like, wake me up when we're down 30.
Yeah, this is nothing.
Right. Yeah, but I feel like a big part of the value is where especially people with platforms get to shine is during market corrections. That said, I mean, you've been in the profession longer than I have, but I'd be curious, do you feel like market corrections are going either faster because people hear from voices like yourself or they're getting more educated that like, hey, this is temporary, you just have to sit through it? What do you think has changed on that front, if anything at all?
It's better than that. I think the public is getting smarter, but I think the mechanisms with which we invest are programmed to negate the effects of bear markets, and it's working. So people, assume like fear and greed and nobody ever changes. I don't know. I think that's probably true, but like what if we all default to a method of investing whereby our money is automatically being added to asset classes that are falling and automatically rebalancing, and then we've got $11 trillion in 401k money in this country. The money being added to those portfolios is price insensitive. It's coming in no matter what. We have data from 2022 is the worst year for a 60-40 portfolio allocation in the history of the universe. These are facts. The absolute worst. And like bonds were down as much as stocks. S&P down 20, bond market down 18. Just a slaughterhouse. There was nowhere to hide except for cash. Okay, fine. What did Vanguard 401k participants do during that year? Literally nothing. They continued to invest. They didn't log in and stop the investments. They didn't tinker with the allocation of their existing investments. They didn't change the new money coming in, like how that would be allocated. Because people they're staying the course. They're emotionally more intelligent. They've seen how fast the recovery was in 2020. They saw how dumb people looked for selling at the bottom of the pandemic. And they've just learned. But then also the way that people's money is being invested, it's a more automated thing. Schwab Intelligent Portfolios, Vanguard's robo-advisor, Betterment, the 401k at Fidelity, the 401k at Vanguard. Like, this is now, I think, dampening volatility, shortening market cycles, making it so that corrections don't go all the way down 60%. I think it's having a positive effect. That it's a combination of technology and the end client, the end investor, just being a little bit more aware of their own behavior.
I'm so glad that you mentioned the Wealthfronts, the Betterments, the Schwab Intelligent Portfolios, because the 401k story a lot of people get. I remember when the robo-advisors were starting to make a name for themselves coming out of the great financial crisis, and most financial advisors were worried about them taking our jobs, and they didn't, but they did start to serve a portion of the population that previously didn't have that kind of good advice. And here's what I think is interesting about that. So I survey my email list and my listeners like once a year, and there's a huge part of my audience that's do-it-yourself investors. And when I serve them and they say the cost of advice is the reason they don't hire an advisor, I do sometimes wonder if that's because they never came up with the automation of the robos. They maybe had the 401k, but it wasn't as automated as it is today. You and I both know that a good financial advisor, worth their weight in gold. A bad one, maybe not, but a good one, definitely worth it. So in your mind, what would you say to that do-it-yourself investor who follows you, follows me, follows lots of good thinkers, has made lots of good choices, but still can't get over the cost of hiring somebody? I mean,
So don't. Like, I think a third of investors are do-it-yourself. That's fine. There's nothing. This is personal preference. All right, let me tell you something. This is interesting. When we hear from a self-directed investor who wants to hire us, do you know what the main reason that we hear the most often for why they've come to us? This is true. What would you guess? What would you guess it is?
I mean, I would say either it's a backup plan for their spouse.
Yeah.
Or
no, that's it. You got it.
That's it. Okay. Yeah. That's usually what I get. Yeah.
Okay. So, hi guys. Big fan of Barry's. I'm 65 years old. I've been managing my own money since my 30s. I had a couple of bad brokers in the 80s and fired those guys, and I've been doing a pretty good job by myself. And I could keep doing this, but I'm worried now. My friends are having heart attacks and strokes and dropping dead, and if, God forbid, something should happen to me, I don't think Ginny would know what to do with the portfolio. She doesn't even know the password. I just want to make sure that I start a relationship with someone I trust now so that, my family can get to know you also, and there's some continuity there. That's number one. It's not people are not incapable of building a portfolio and managing it. The thing that becomes more real to them is this realization that they don't have forever. And so the secondary component to that, Peter, is like, all right, I'm pretty healthy. I don't have any history in my family of cancer or coronary stuff. I think I got another 20, 30 years. How many days of that 20 or 30 years do I want to spend sitting in front of a computer playing clips of Jim Cramer or reading about the Federal Reserve or whatever? Like, how much of my time do I want to dedicate to selecting international stock ETFs or calculating tax losses for capital gains tax? I think the intelligent, professional person who has already given over a huge portion of their time to building this nest egg now recognizes, like, life would be better spent if I had professionals taking care of this stuff. And the truth is, the cost is not high, especially if you prevent people from making tax mistakes, insurance mistakes, asset allocation mistakes. So that's the enlightened, self-directed person who eventually comes along and says, all right, that was cool, I did it. Now I want to spend my time doing something else. That's a great client. We do really well with those people. I think we provide levels of expertise that they don't even know what they're missing. By the time they talk with all the people that work at my firm, all the different subject matter experts, they're like, oh my God, I should have done this 10 years ago. But it's okay. There's absolutely nothing wrong with that. I don't think everyone needs a financial advisor. I think everyone deserves a financial advisor if they want one. And I think that's a really important distinction.
Well put. I always equate it to, like, I hired someone to mow the lawn when I had my first kid. I can mow the lawn. I still can mow the lawn if I want. It's not like it's that hard per se. It's just at a certain point, you want someone else to do it. Now, I've now started paying more for my lawn people, and they do an even better job. Different discussion. And
yeah, you're fancy now. I heard about your landscaping.
Actually, when we bought our house, we didn't have like a big yard. Our first house was small and like a traditional starter home, but we were looking at houses for our second, and the realtor's like, "Oh, they have water and irrigation. They have a sprinkler system." I'm like, "That'll cost a lot of money." She goes, "If you're gonna buy a big boy house, you have to do big boy things." I was like, "Oh, yeah. Okay, yeah." Well, hey,
that's
we're
not
talking
emasculating
about a lot of
at all.
No,
Said that in front of your wife.
She did.
You were like, "I am a big boy."
Yes. It helped that she was the mother of one of my wife's best childhood friends, so she probably still looks at us as kids, which I'm cool with.
We'll give her a
let
pass.
it slide.
Yeah.
For those listening, I have been pulling stuff from your new book to talk about a little bit. Fantastic stuff. When I was reading this, actually, so first of all, you're pulling some of your best blog posts and then updating them with comments, which is phenomenal, and I didn't know that going in. I'm reading this, I'm like, wait, I feel like I've read this before, and then it becomes clear as you're making remarks. The one thing, though, I pulled another book from my bookshelf that I'm going to link to in the show notes called Bull, because I didn't work in the 90s during the bull market, and I felt like...
That's a classic. What's her name? What's the author's name that wrote
Maggie
that?
Marr.
Maggie Marr? Yeah.
Yeah, and, for me... it was sort of like the book I read as a young professional to better get a sense of like what was going on.
What did you just miss?
Yeah, right. And 100%. I think your book is going to do that for a lot of people. And then for those who didn't miss it, it's going to remind them of like where we came from, because it's really easy to come up with reasons with why the world looks terrible, like why the outlook looks terrible. You do such a good job of like replaying this is where we were. With all of that in mind, kind of putting you a little on the spot, could you give a reason or two or five or whatever for why people should be optimistic about the future?
Well, the optimists always win in America. Not in every country, not all over the world. I happen to believe that American-style capitalism is the best system of any ever devised by man. And my proof of that is... look at these multi-trillion-dollar corporations we have. Look at the incredible products and services that fill our lives, things that are so miraculous that it's amazing the extent to which we take them for granted. Just look at the way life has changed. I'm almost 50 years old, so like I'm born in 77, and just in the course of my life, let alone the lifespan of somebody who is 60 or 70 or 80, It's miracle after miracle after miracle, and we may not feel this way every day, but things do continue to get better. So Long Island is a hotbed of breast cancer. In the 1980s and 90s, we just, I don't know what the reason is. I know there are scientists that have theories, but breast cancer is more prevalent on Long Island, I think, than anywhere else in the country and maybe the world. And we don't specifically know why, or maybe someone does, but it was a death sentence. If someone you loved was diagnosed with breast cancer, it was pretty much like, okay, that's it. Mom's gone. We have millions and millions of survivors, people's wives, mothers, daughters, aunts, sisters, who not only survive but thrive in the aftermath of that diagnosis. It's miraculous. If you had shown the survival rates of today's breast cancer, if you had shown the number of people surviving and then living a full lifespan after a breast cancer diagnosis for people in 2024, if you were able to show these statistics to people in 1994, they would fall on their fucking knees. Okay? So we take that for granted because it's so gradual. It's not like Jonas Salk invents a cure for polio, which also changed the world. And it's like this momentous thing, and then everyone goes and gets the vaccine, and they give it in schools and the army. And okay, so this was a more gradual thing, but it's equally, if not more, miraculous. And these miracles are happening all around us all the time. In the presence of that knowledge, how could you be anything but optimistic? Like, look at the ways in which we're developing the real estate in some of our cities in this country. Look at the buildings that are going up, the high-speed rail. You could always complain and say it's not good enough, it's not fast enough, there's still too much crime. Of course, we could all do that. Nobody makes money as a result of doing that. So I think we are really good as both a race, the human race, but then also like as Americans, we're really good at diagnosing problems. There are a lot of people who just stop right there. Here are all the problems. Here's what I'm mad about, and tweet it out. Okay, but then there are people who say, all right, that is a problem. How do we solve it? How do we make money with the solution? I think that's what's amazing about us. And so that's the source, and that's where the optimism as a default setting idea comes from. It doesn't mean the stock market always goes up. It doesn't mean the economy is fair for everyone. I'm not saying that. I'm saying, my God, if you have to pick one, if you had to pick one demeanor to have as an investor, it should not be cynicism. It should not be pessimism. It's got to be optimism, or you're going to get left behind, because the optimists over long stretches of time, and Warren Buffett is the prime example of this, they win. They win big. So that's where I'm coming from. I'm as sarcastic as anyone else from New York. You know that.
Yep.
But like the big picture thing is like, guys, not everything works out, but the big stuff, we get it right in the end.
Well, and about half of my client base is going to be unhappy based on how the election turns out. And I try to echo this. You don't want to bet against the human spirit. And if you look at like the last 3 big events, at least in my career, and I guess maybe in the last 20 years of markets, 20, 30 years of markets, they're all things you wouldn't have been able to predict anyways. Like you wouldn't have been able to predict 9/11 or the financial crisis or COVID. I mean, these are big shocks that aren't priced into markets. And as a result, that's where the chaos comes, that we're all worried about getting hit with the big one. But if you just sort of accept that the big one is going to come with a similar magnitude and frequency as it has in the past, let's just have a plan for it and trust that the human spirit's really strong. That's what's going to lead you to better results.
So you have 2 choices. You could lie to people and tell them that you could predict.
Yeah.
Okay, you could do that.
Yeah. People do that. It's really frustrating.
Well, you just make a new prediction a year later and everyone forgets the last one. A lot of people think, and I understand it, they think their job as investors is to figure out what's going to happen in the future and then invest based on that. I think the more enlightened investor, and certainly most financial advisors, understand that that's not what we're doing. What we're actually doing is we're saying this is the potential range of outcomes probabilistically that we should be prepared for. And then every once in a while, there's going to be this really crazy thing from outer space, this exogenous shock that by definition can't be predicted. And it's going to have a really big short-term impact on the market. And we have to build a portfolio that is durable enough so that we can make money from the expected range of probabilities, and we don't get the knockout punch from that exogenous shock that's coming no matter what we do any day now. That is the enlightened way to allocate assets. Unfortunately, it means that if a best case scenario takes place, we're going to be underweight relative to what we wish we were. Why do I own bonds? Why am I wasting time with treasuries when I could have just bought the 5 best FANG stocks? I could have bought Apple, Microsoft, NVIDIA. Why do I own anything else? Okay, fine. If that's your worst case scenario, that you could have made more money, but you still made money, every advisor can talk a client through that and live through that. What we can't do is take so much risk and try to capture so much upside that when that exogenous shock comes, it's a knockout punch, and we're out of the game because we've just been absolutely annihilated. Like, that's what we can't do. So this is not about guessing the future. This is not about allocating toward one specific outcome based on a prediction. This is really about surviving and thriving.
Josh, I know I only have you for a little bit longer, so kind of a wrap up with a few behind the scenes questions. Knowing that your book is some of your best writing from over the years, but certainly not exclusively. I mean, you definitely have other stuff that didn't make it in there. How did you choose what to put in the book and what not?
So we use each chapter is based on a blog post that had been really popular at the time it was written, but that's the historical blog post is only meant to be a jumping off point for me to bring these concepts up into the present and decide what has changed, what hasn't changed, what can we learn about investing, as a result of this idea. So the things that made it into the book were things that were worth revisiting and updating. So it's an extremely modern take on investing, because what I'm doing is I'm saying this was an insight I had in 2017. Everybody read it. The blog post went viral. Here's why it was so popular at the time. Are the things I was saying still true today? And if not, why not? What's happened? Have I changed my mind? And I found that was a really interesting process, because what I'm basically doing is telling the story of the last 15 years of investing, but I'm doing it in service to what's to come in the next 15 years. And so it's not really a greatest hits per se. It's taking these ideas from the last 15 years of blogging and explaining why they matter right now to investors and what they might mean for the future. So it was a lot of fun to write, and it was a lot of fun to challenge myself to try to think about things in that way.
Always fun to revisit some of the good ones. And I got to say, even though we don't have time to go down the rabbit hole of it, I was thrilled when I saw the $100 bill store analogy in there. Quite possibly the most useful analogy put in front of me in a 2-year period where one set of stocks were doing really well and another set weren't. And truly the best thing you got. Again, I'll tease that and let people buy the book to go read it. I won't even link to the blog post it came to, so we can get people to check out the book. The last question I have is actually off the book. You had a consulting role, or maybe you can tell me the exact title that you carried in the Showtime series Billions. Tell me a little bit about that. Like, how did that come about? Like, that sounds super cool. What are things that, in your unique position as a regular CNBC commentator, a blogger, a huge media footprint on the podcast and YouTube side, like, what did you bring to the table? What did that look like? Anything that you can share behind the scenes, would love to hear it.
Yeah, so that was some of the most fun I ever had professionally. In season 3, the creators and showrunners of Billions, Brian Koppelman and David Levine, came to me. They needed a technical advisor, somebody who could read the scripts and help them get the dialogue right amongst the Wall Street characters. So Billions is really like 2 shows in one. Half the cast are like U.S. attorneys and people involved in the legal side, like Paul Giamatti's character, Chuck. And then the other half are hedge fund and Wall Street people. So my job is to read the Wall Street parts of the scripts and make sure they rang true. One of the really cool things about Billions, and the reason why it's so beloved on Wall Street, is because they did go that extra mile to, even if the plots were not plausible, at least the banter between the people working on trading floors was plausible. So I got to do that season 4, season 5, season 6, season 7. I did that for about 5 years, interrupted for a year by the pandemic. And I also got to play myself on the show, which
I was
going
to mention that. Cool cameo appearance.
It was my most challenging role to date. I had a couple of scenes in an episode during season 4, and then I got to be on the series finale. They had me on the TV screen, kind of playing a little bit of a role and explaining what had just happened on the show. So it was really one of the coolest experiences ever. And to this day, I still hear people say, Billions is my favorite show, and thanks for helping make it as realistic as it was at times. So.
Well, it was super cool me knowing you and you having helped me at a couple of times throughout my career. To see you on that stage was super cool. I'm like, I know that guy. So very, very cool stuff. And Josh, again, I appreciate you giving me the time here today. I'm going to link to all sorts of your stuff in the show notes at thelongterminvestor.com, but anywhere you want people to go and find you.
No, don't. It's enough with me. Just read the book. You don't have to find me.
They're going to find TCAF. They're going to find all the stuff.
Yeah,
we'll get the book. It'll be at the top of the post.
It's great. I feel like it's almost too much. So if after listening to my voice for the last 45 minutes you need more, I'm on YouTube. I'm on a podcast. Feel free to follow and subscribe. We love our audience. And Peter, I want to end by thanking you for having me on to talk about the book and all that you do for the advisor community, the investor community. I think you're terrific, and it's always a pleasure to catch up with you.
All right. Well, we're going to sign off here and keep giving each other compliments, but be sure to share, subscribe, do all the things. Josh, thanks again, and we'll see you all next time.
Thank you, Peter.